For any investor out there, there's one tool that cuts right through all the noise, all the hype, and shows you what a company is really made of. It's called the balance sheet. And in this explainer, we're going to break it all down and show you exactly how to read it.
You know, it doesn't matter if you're just starting out or if you've been doing this for years. Every single investor faces this exact question. Is this company actually strong? Is it stable? Is it worth putting my money into? Well, lucky for us, the answer is usually hiding in plain sight.
I want you to think of a balance sheet like a company's annual physical. It's a snapshot, a really detailed health report that tells you exactly where that company stands financially on one specific day. It's not about how it performed over the last year, it's about its condition right now.
So, our financial checkup today has 6 parts. We're going to start with what the company owns, its assets, and then what it owes, its liabilities. From there, we'll figure out its true net worth, or its equity. And then comes the fun part. We'll check its vital signs with some key numbers, so you can make your final, super-informed diagnosis.
Okay, let's dive into our examination, starting with Section 1, Assets. Just think of these as all the company's strengths, everything it owns, from the cash it has in the bank to the buildings and equipment it uses to make its products. These are the tools it's going to use to make money in the future.
So, what exactly does a healthy set of assets look like? Well, first off, a big pile of cash is always a great sign. It gives a company options. You also want to see that they're managing their inventory well, so they're not just stuck with a warehouse full of last year's stuff. And finally, you check out their accounts receivable. That's money their customers owe them. You want to make sure those bills are getting paid on time.
Okay, now this table tells a really cool story. Look at the cash. It more than doubled in just 1 year. That's a massive sign of strength. But here's the kicker. Look closer. The inventory actually went down. Now that combination is incredible. It means the company is selling its products like crazy and turning them into cold, hard cash, not just letting them collect dust. This is a perfect picture of a company getting way more efficient.
All right, let's look at the other side of the coin, liabilities. These are all the company's IOUs, the money it owes to other people. Now, debt isn't automatically a bad thing. For a healthy company, it's kind of like a manageable condition. It just needs to be monitored and kept under control.
So, how do we check if those short-term debts are under control? It's actually a pretty simple comparison. Here we've got a company with $4.5 billion in current assets and $3 billion in current liabilities. I mean, you can just see it right there. They have more than enough to cover their immediate bills. But let's put a real number on it. And that brings us to our very first vital sign, the current ratio. In this case, it's 1.5. A number over 1 is what you're looking for. It means the company has more short-term assets than short-term debts. So a score of 1.5, that isn't just healthy. It's a really strong sign of financial stability. They can breathe easy.
But what about the debts that aren't due this year? We call that long-term debt. And yeah, it's like that chronic condition we talked about. It's not an emergency, but you absolutely have to manage it carefully. And the key vital sign we use to keep an eye on that is the debt-to-equity ratio.
Now, a debt-to-equity ratio of 0.5 is fantastic. Seriously, it means that for every single dollar of debt the company has, it's got $2 of its own equity backing it up. As a rule of thumb, anything under 1.0 is considered pretty stable. It shows the company isn't relying too heavily on borrowing, which means it can handle tough times a lot better.
So, we've looked at what a company owns and what it owes. So, what happens when you put them together? Well, you get equity. And this, my friends, is the bottom line. It's the ultimate measure of a company's net worth. It's what will be left for the shareholders if the company sold everything it owned and paid off every single one of its debts.
And this right here, this is probably the most important formula in all of accounting. Assets minus liabilities equals equity. That's it. This one simple little equation is the entire point of the balance sheet. It all boils down to showing you a company's true net worth.
When you're looking at equity, you're really just asking 2 simple questions. First, is it positive? This is like a basic pass-fail test. It just means the company owns more than it owes. And second, is it growing year after year? A company that's consistently building its equity is a company that's creating real, lasting value. That's what we want to see.
Let's just plug in some numbers to see how this works. Say a company has $9 billion in total assets, and it has $5.5 billion in total liabilities. Well, you do the math, and its shareholders' equity is $3.5 billion. That positive number tells us the company is in the black and has created real value for its owners. All right, we've looked at all the individual parts. Now it's time to put on our doctor's coat and check the vital signs. These 4 key ratios are going to let you make a quick but really powerful diagnosis of any company's financial health.
Think of this table as your ultimate diagnostic toolkit. You'll recognize the current ratio for short-term health and the debt-to-equity ratio for long-term risk. We've added two more here. The quick ratio is an even stricter test of a company's ability to pay its bills because it ignores inventory. And then there's return on equity, or ROE. This one's a big deal. It tells you how good a company is at using its shareholders' money to make a profit. And that ideal range column, that's your cheat sheet for what a good result looks like.
Okay, theory is great, but let's see how this works on a real patient. We're going to do a quick checkup on a company I think we all know, Apple. Let's see how its vitals look.
Wow, okay. The scale here is just immense. We're talking $380 billion in assets balanced against $280 billion in liabilities. That leaves a massive $100 billion in shareholder equity. But remember, the raw numbers only tell part of the story. Let's check those vital signs.
So we run the numbers and, yep, we get a pretty clear diagnosis. Apple's current ratio is 1.1, so it's safely above that 1.0 line. It can definitely cover its immediate bills. Even more impressive, its debt to equity is 0.7. That means its debt is well managed and totally reasonable. The final diagnosis, this is one very strong, very healthy company.
All right, now it's your turn. We've given you the tools, we've walked through an example. So here it is, your final checklist. 4 simple but incredibly powerful questions to ask before you even think about investing in a company.
Here it is, your final 4-step process. You start with the absolute basics. Does the company own more than it owes? Then you check its risk level by looking at its debt. After that, you make sure it has enough cash to be flexible. And finally, you confirm that it's actually creating value by checking if its net worth is going up over time.
And why does this checklist matter so much? Because a healthy balance sheet is the foundation of everything. It proves a company can survive the tough times, that it isn't taking on way too much risk, that it has the flexibility to pounce on new opportunities, and most importantly, that it's building real, sustainable value for its owners. You now have the tools to pop the hood on any public company and really see what's going on with its financial health. So the only question left is, who's first on your examination table? Which company are you going to give a financial checkup to next?